Good afternoon, everybody. Good afternoon, participants. Good afternoon, Mr. Iyer. On behalf of Bombay Chamber and also on my personal behalf, I would like to welcome Mr. Prahladan Iyer, Chief General Manager, Export Import Bank of India, for this business masterclass with our project clients. I'll just give a brief background about Bombay Chamber. Chamber is one of the oldest industry associations in India, so over 180 years, with several thousands of corporate members across a wide spectrum of industries. While a third of them represent large corporates with global footprint, two-thirds consist of startups, small and medium-sized enterprises. The Chamber strives to serve as a connector between industry and government, mainly focusing on regulatory aspects, business growth, and playing the role of a facilitator. The Chamber also offers a large bouquet of services such as advocacy, capacity building, trade facilitation, business networking, and handholding of SMEs and our partners. Its labor advisory and legal services are available by several corporates as well. The Chamber engages with multilateral agencies such as World Bank, IFC, ADB, similar multinational agencies with activities pertaining to development of bilateral trade and industrial growth. It actively supports incoming business delegations and facilitates B2B partnerships. The Chamber publicizes country updates on the basis of economic data received from diplomatic missions. The Chamber offers certificate of origin services to a large number of our exporters, almost 2,000 plus, across the country. The department is known for its speed and quality of online services, and our visa recommendation services are available by members and are recognized by all major diplomatic agencies. The board follows 4 mission elements, namely 1, sustainable economic growth while balancing it with climate change. 2nd, ease of doing business. 3rd, unlocking the potential powerhouse of women and integrating into economy, building initiatives, and also very aptly on the digital strategies. And as most of you are aware, Bombay Chamber is involved with this project on the internationalization of SMEs across the Great Mekong sub-region, Cambodia, Thailand, and Vietnam, and India. The project is at advanced stage wherein around 500 SMEs have gone through the training cycle. Almost 70% are going through mentorship. Many of them have now started B2B partner search, and some of them also have signed MOU prior to finalizing their collaboration. The bank has also played a critical role in supporting Indian industries in their globalization efforts. Mr. Iyer, your insights and advice from today's masterclass definitely will be bring in a lot of value add to the participants. And without much delay, I would like to hand over the session to you. Thank you very much, Mr. Iyer, for making it convenient to accept our invitation and being a part of this event. Look forward to hear from you. Thank you.
Thank you. Thank you very much. Thanks to Bombay Chamber for this opportunity to share my perspectives on trade opportunities and financing options from EXIM Bank for doing business in the ASEAN region. I am happy to note that some ASEAN member countries, SMEs, are also part of this webinar. I greet all of them on behalf of EXIM Bank. The structure of today's presentation is I am going to give some wisdom on the SMEs and the need for internationalization. And the next section will be India's trade and investment relations with ASEAN countries. Here I will talk about both the trade, export, import, and also the investment and the FTA with which India has signed with the ASEAN countries, what kind of an impact, how it is impacting, especially from an Indian perspective. And the third and last section is about financing options are there for EXIM Bank, from EXIM Bank for the audience here today, if they would like to avail any of such facilities. So first is to start with why the SMEs need to internationalize or globalize. One is basically globalization. They provide a platform to SMEs for integrate with in the global value chain. It gives access to global market for SMEs, especially in the larger and niche markets. It helps prospective high growth firms to realize their growth potential. There are possibilities to exploit economies of scale because you are enhancing the canvas of the market, and you also get technological advantages because when you explore borders, then you will get to know the newer technologies and how you should adapt such technologies, upgrading the technological capability through R&D. So you need to also invest in R&D in order to enter into the international markets. So basically, this is pictorially presented the scope and importance of international market. I will first talk about the importance. You can get the foreign exchange earnings and you can utilize optimally your resources because your canvas is larger. You can do business expansion because of which you can achieve economies of scale. You are diversifying the business risks through international operations. It is, of course, it is applicable to smaller economies, not like a large economies, but for the smaller economies who are looking at only the domestic market, this may not provide them a larger platform for their exploration. Then the fifth one is achieving organizational goals, which is to make profit and also improving organizational efficiency. Then there is also tax benefits because you are going into a market where if there are double taxation avoidance agreements, then you can also get the tax advantage. In overall, you will have an enhanced competitive capacity. So that is the importance of exploring the international markets. Now I am coming to the left side of this slide, which is the scope. One is you can do it through international marketing, manufacturing from here, and the international finance and investments. That is another scope with which you can do. And the third one is the foreign exchange you are earning, and because of which you gain additional revenue. Then the global human resources are available to explore. So these are the basic scope for while doing the international business. These are the few methods of internationalization. Only you can do international exposure, you can take only by exporting, or you can undertake licensing or contract manufacturing with an international license, or you can also give licensing of manufacturing to an overseas entity. You can operate under the franchisee model. You can enter into management contracts and undertake contract manufacturing. You can also do direct investment. You can enter into strategic alliances. You can set up a wholly owned subsidiaries. And it's not necessarily in one region or one country. You can, in fact, perhaps go into the entire spectrum of the globe. And alternatively, you have the choice of even doing the portfolio investments. So these are the dynamics which are affecting international business environment. I start the last one first, international sanctions. You may be doing business with Russia because of sanctions. Now your business may get affected. So these are the kind of business environment which is emerging. Other major factors are like developing countries' attitude towards FDI. Many countries are welcoming, some countries are not welcoming. Then there are export-oriented strategies which are being adopted by many developing countries. So that gives you competition. Technological development is one aspect. R&D investment requirements is another aspect. Dynamics of narrowing tariff-related trade barriers and also increasing non-tariff barriers. This is another area which is affecting the international business. Because of non-tariff barriers, many companies are unable to enter into various markets. Then there is also regionalism and trade agreements that also position yourself with strength or weaknesses. Like for example, RCEP, in the context of ASEAN, I am talking about RCEP. India is not a party to it. There could be strategic reasons behind the government of India to look at the RCEP in a different way. But this kind of a regional and trade agreements always provide larger canvas and market. There is also increasing demand for capital. So that is the need. You may also invite capital and foreigners to invest in your company, or you can also do investment in the overseas companies. There is also diminishing effectiveness of national borders. Now the global village is a concept. The global value chains and increasing interdependency among nations that has been increasing. And the advent of internet, IoT, then the industry 4.0, all these are like the dynamics that are affecting international business environment. With this limited wisdom, I would like to go to the next section, which is India's trade and investment with the ASEAN countries. So this gives the picture of our trade with the ASEAN. The blue graph, blue color bar that shows the import, and the export is shown in the orange. And the trade balance, you will see that from 2011 onwards till even 2020-21, we have been meeting a deficit, trade deficit with ASEAN. We signed the FTA with ASEAN in the year 2010. If you look at it, overall, our export, just point to point, if you look at it from 2011-12 to 2021, 36.7 billion was our exports then, and now it has become about 31. If you look at it, other than 2018-19, where we have exceeded the benchmark of 36.7, in all other countries, we were below the 36.7 billion, which was witnessed in the year 2011-12. On the contrary, if you look at it, our imports, you will find that the imports have grown, and it has touched the all-time high of about 59.3. Last year, that is 2021, of course, it's a COVID impacted business. So this year we had about 47 billion. So overall, if you look at it, our trade deficit has almost tripled, like 5.4 billion was in the year 2011-12, which has increased to about 15.9 billion. So this is just the graph, just the data, but I am coming to more analysis in my subsequent slides. So what are we exporting and what are we importing? So petroleum products is one of the major export items, then ships, boats and floating structure, iron and steel, aluminum products, buffalo meat, drugs and formalists, then organic chemicals. So these are the major items of exports. And the major items of imports, you will find vegetable oils, coal, coke and briquettes, telecom instruments mainly from Malaysia, Thailand, computer hardware, again, Malaysia, Thailand, electronic components, again, Malaysia, Thailand. Vegetable oil, of course, Malaysia is one of the major suppliers. In addition to that, we also have something coming from Indonesia and other ASEAN countries. Coal, coke and briquettes, mainly you will find our imports are coming from Indonesia, Philippines, like that. So this is the deficit chart. You may look at it with Singapore. Of course, Singapore is a city-state. It's only about 440 square kilometers. It doesn't have a huge market. But Singapore, because we have a SIPA agreement, many of our exports to other regions of the ASEAN is routed through Singapore. So that could be the reason we are having a huge deficit of about 4.6 billion, followed by Malaysia. Indonesia is again another big. Of course, with Indonesia, we are importing a lot of coal. So some of the resources which we, natural resources which we import. So that is the main reason. And except the Philippines, Myanmar, Cambodia, and Laos, all other countries we are having deficit. And on the right-hand side, there is a chart. We have estimated that there is an untapped export potential for India to the extent of about 32 billion. This we have done some simulation exercise using the ITC trade map, and with which we have found that we have still export potential of about 8.5 billion to Vietnam and 5.5 billion to Indonesia, about 4.6 billion to Thailand, and with about 5.8 billion to Malaysia. So of course, you have a smaller this one. Even Singapore is also, of course, the potential is huge with about approximately about 4 billion. So overall, if you look at it, India could export another 32 billion. Already we are exporting something like about For the ASEAN region, 31 billion, we could definitely double. There is a potential. So that is what the simulation exercise provided us. Now I'm coming to investments. You will find that I have given the data in million in order to get these like Cambodia, Brunei, and Myanmar, Vietnam, all these to appear in the investment. So that is the reason. Because of SICA with Singapore, and Singapore is also attractive tax efficiency. So that is why large amount of volume of investments are going up and down between India and Singapore. What are the key factors that make Singapore a preferred hub for business? Ease of starting and doing business, gateway to the ASEAN region. We have an extensive agreements and the treaties. They also have an extensive agreement and treaties with the rest of the ASEAN, and ASEAN in turn have with Australia, Korea, Japan, China separately. Now RCEP, under the RCEP umbrella also, Singapore is connected, well connected. Then the conducive tax regime they have, I already mentioned to you, robust infrastructure and efficient bureaucracy. And it is emerging as a financial hub next to Hong Kong or Tokyo. Then the immigration requirements are easier. So as compared to many other countries, especially other developed countries, IP protection regime is also high, efficient dispute resolution mechanism, and the limited export-import duties. That is one of the attractive proposition Singapore is offering, which makes many countries route their investment to India through Singapore. This one is based on FDI markets. FDI markets tracks the cross-border investment in a physical project or expansion of an existing investment that creates new jobs and capital investment. This data, of course, is more like, I would say, investment announcement and may not have been fully invested. Like, for example, I am just giving you this 2016, about 6 billion was the investment intentions or investment announcements by India in the ASEAN region. It is only an announcement, but the investments could happen over a period of 3 years, or some investments, they may even drop it. So that is the kind of data insufficiency we have. So with which we have worked and we have got this data from FDI markets. This data, of course, differs from the official data on FDI flows, as company can raise capital locally, phase their investment over a period of time, and they can also channel their investment through different countries for tax efficiency. So I am just going back again to the previous slide to show that this Singapore here is appearing high because this one is an official statistics and this one is not considering several other factors, because Singapore as a hub, investment hub, many countries invest into India through Singapore, so that you will not get to know which countries are investing. So that is why this analysis of that FDI database which we have used, if you look at here, you will find that again, the share in investment announcements by India in ASEAN, Singapore is a major market, around about 80%. And followed by Malaysia, then Thailand, Philippines. So these are the regions in which India has announced investment decisions, or Indian companies have announced. This is for a period, a decadal period, 2011 to 21. And in terms of sectors, real estate, that is one of the major sectors, followed by coal, oil and gas, chemicals, renewable energy, transportation, warehousing, all these. So these are the greenfield investment announcements by the ASEAN into India. So this is the reverse of the previous one. So here you will find that mostly the investments, the major investor is Indonesia, then Singapore, then Vietnam, Myanmar, Philippines. These are the people who have expressed their interest to do investments over the last 10 years. And approximately about 14.6 billion were the investment announcements during the whole 10 years. And the sectors here are like coal, oil and gas, software and IT services, business services, metals, rubber, like that. So this is again FDI database, sourced from the FDI markets database. These are not official statistics, but it gives an indicative investment announcement sector-wise as well as from countries. So this, I'm just rushing through these slides. Here it is all the 10 ASEAN countries we have taken into account, how much we are exporting, how much we are importing, and what are the major exported items, what are the major imported items. You will find that Brunei is a major oil exporter to India. You will find that out of 300 million, 96% is oil. And our exports, mainly we are exporting motor vehicles and cars. So these are the India's trade with Cambodia. So here we are having a surplus, trade surplus we have. So mainly drugs and formulations, buffalo meat, and man-made yarn and fabrics. Majority of them, these are the products we are exporting. And what we import is RMG, means ready-made garments, electronic components, cotton RMG, ready-made garments made of cotton. This is the trade with Indonesia. We run a huge deficit. You will find that the deficit has touched the peak to about 12.5 billion with Indonesia. And we have also seen earlier also Indonesia has the potential to export more. What we export ship, boat and floating structure, sugar, iron and steel, organic chemicals, buffalo meat. And what we import, coal, coke, briquettes, vegetable oils. So these are the two major items. These are the trade with the Lavopedia. We have had almost a deficit, but the last 3 years we are making a marginal surplus with the Lavopedia. Again, petroleum products is a major import item. Electrical machinery, drugs and formulations are our major exported items. These are the trade with Malaysia. We have been having consistent trade deficit with Malaysia. Aluminum products, petroleum products, buffalo meat, and organic chemicals are the major export items. Vegetable oils, petroleum, and computer hardware peripherals are the major import items. So this is the picture of Myanmar. Pulses is the major imported item by India. And we export drugs and industrial machinery. We have a very marginal surplus with Myanmar. This is with the Philippines. We have been having a good trade surplus with the Philippines. And it is diversified in terms of imports. Gold, then copper, computer hardware, then electronics are the major imported items, drugs formulations, iron and steel, buffalo meat, these are the major exported items. This is Singapore. Singapore, of course, we don't, whatever we export, like, you know, about $13 billion of import and $8.7 billion of exports. See, these are not necessarily destined to Singapore. It could go to other regions also. So you will have to take this data, whatever is given here, with a pinch of doubt. For example, I am just giving you this, what we exported, petroleum products. I don't think so. Petroleum, Singapore is a huge consumer because they discourage the car movements. They tax heavily the cars, and even the second car, if you have to own, you need to take permission. Parking is huge, expensive. So probably the exports are going and re-exported to some other region. So that could be the takeaway we can have. Thailand, we have been having a consistent trade deficit, and major export items are like plastics, organic chemicals, AC refrigeration machinery, and major export items are pearls, semi-precious stones, IC engines, etc. This is the trade with Vietnam. We have had a surplus, but last 3 years, we are facing a marginal deficit. So now I am coming to the crux of this, like how this ASEAN-India free trade agreement is impacting. The existing free trade agreement between India and ASEAN encompasses trade in goods, services, and investment. Initially, we signed only trades, then subsequently we have had a comprehensive engagement with the inclusion of services and investment. The preferential imports account for 70% of imports of India from ASEAN. India has extended zero, near zero, and low preferential tariffs in most of the products. Just to give you an example, except tea, coffee, oil seeds, that has the with a weighted average tariff of 15.2%. This is, of course, double than the MFN rate. MFN rate is more than 30%. So 15.2% for these products. Other than that, in all other products, we have extended 0 or near 0 or low preferential tariff, approximately averaging to around 5%. And what ASEAN has offered to us, they have offered preferential imports of by ASEAN from India that covers only 48% of imports. So here itself, you find a stark difference that while we have offered 70% of our imports concession, and ASEAN has offered only 48% of their imports concession. So that is one of the major difference here. Some tariff lines like cereals in the imported by ASEAN, they have a preferential tariff of 3.8%, while the MFN is 9.5%, which is almost 3 times. After the agreement came into effect in 2010, India's cumulative imports of top 10 items from the ASEAN member countries, that they have registered an AGR of 13.3%, which is very, very high as compared to an annual average growth rate of 4.1% recorded for India's imports of these items from the rest of the world. This we have also seen in the beginning. I showed the chart how in the last 1 decade, our imports have declined, our exports have increased with the ASEAN. See, this we have done a quick analysis. These are the top 10 items. We have used the HS2 digits. These are the top 10 items. In these top 10 items, where we have a significant impact, where the FTA agreement is not so significant, and where we have a moderate kind of impact we have. So you will find that mostly you have like moderate 1, 2, 3. In 3 out of 10, 3 are moderate and 1, 2 are insignificant. So even if you remove these 5 out of 10, which are the top 10 items, 5 items we have significant impact, not in favor of India. So that is the crux of it. So I have given this data anyway. This presentation will be shared with BCCI, and that could be in turn accessed by the participants and other members of Bombay Chamber. Basically, the 5 2-digit items in which the India-ASEAN FTA has affected India is given here. Just a minute. Okay. So we did a trade intensity index analysis also. I'll just brief what is that. That it is mainly the trade intensity index is used to determine whether the value of trade between 2 countries is greater or smaller than that would be expected to based on their importance in the world trade. So how you will be comparing it, the trade with a particular region with the rest of the world. So that with that you will get a trade intensity index. Anything above 1 is absolutely fine. Anything below 1, that means we have had a negative impact in those products. So again, we have done some top items in which you will find that most of them are like above 1, and only 2 items, that is natural or cultured pearls, precious, semi-precious stones, and electrical machinery and equipment. In these 2, our trade intensity index is lower than 1. So that means in these 2 items, we haven't got the much required benefit by having this FTA with the ASEAN. So now I'm coming to the last section. I'll quickly run through what kind of financing options are there. Then I can take question answers if you have any queries on those. One graph explains what are we and what kind of services we are offering and where we are operating. We are set up under an Act of Parliament in 1981. We are engaged into medium to long-term support, international trade and investment. So the short-term credit, export credit is provided by the commercial banks. We are providing medium to long-term export credit. And 80% of our lending operations is in foreign currency. We are, because 100% owned by the government of India, we are proxy to the India's sovereign in the international debt market. So if India is rated BBB minus, we are also rated BBB minus at par with the sovereign. We are a policy bank for economic diplomacy operated by India. Then our direct finance is about 89% and refinance is about 11%. These are the region-wise exposure. You will find that South Asia, especially, you will find that our exposure to Nepal, Sri Lanka, Bangladesh are very high. Followed by West Africa, then Southern Africa, North Africa, basically the African region. We have huge exposure. In all, if you look at it, our exposures are mostly in the developing countries. Of course, we also have in America, Europe, and other places also, but our exposure is limited. And in terms of portfolio, you will find that export finance, again, I am repeating, it is medium to long term, not short term. That export finance is about 75% of our total loan portfolio. And on the non-funded portfolio, we give performance guarantee, which is very high. The guarantees, basically these are guarantees, performance guarantee, advance payment guarantee. These are the two guarantees which are issued to the project exporters. So on this side, we have the what we call as export finance or trade finance. I mentioned to you, it is medium to long-term export credit. So by way of lines of credit, buyer's credit, this is, of course, pre-shipment and post-shipment are short-term export credit. We do operate in this area, but our exposure is very, very limited, unlike commercial banks. Then we also issue guarantees. And on the export capability creation, because we felt that India is a vast country, we need not work with the existing exporters. We need to create new exporters. So that is why we have introduced a range of programs. We have term loans, working capital term loans, then export product development finance, export facilitation finance, then we give overseas investment finance. We also give import finance. Of course, this import is not for consumption. This import, you need to do value addition after importing. It could be machinery, equipment, or raw materials, or intermediate items, but you have to use our finance, import it, and do value addition. Again, I just take half a minute to digress from this. If you look at EXIM Bank E, you have a logo E. That logo, there is an inward arrow and there is an outward arrow. That inward arrow signifies import. We also support import. And the outward arrow signifies the exports. So you will find also that inward arrow is thinner than the export arrow. It means that we support import provided you manufacture, value add, and export much larger than what you import. So this is the crux of the logo or the story of the logo. We finance R&D. We also finance, there is something called Ubarte Sitare program. I will talk to you about that in a little bit detail. Lines of credit, it is a proactive mechanism to promote exports of goods and services. What is lines of credit? Instead of giving support to the Indian exporter, we are giving financing to an overseas importer so that he uses that finance and import from India. There is a condition that the beneficiary, that is the importer who is using that finance, has to mandatorily import from India. So that is the condition. So this is the another model of export promotion through financing the importers. This helped the recipient countries in accessing AAA technologies, appropriate, adaptable, and affordable. That is what we call it, because in a developing country context, we know that which technology will suit another developing country. For them, you give them something industry 4.0 or artificial intelligence, though in manufacturing, all these will not help majority of them. So you need to give an appropriate technology to them. So that is why we call it as AAA technologies. Many of the LOCs are earmarked for infrastructure and related projects. These are government to government lines of credit majorly, and we are the executing agency for that. So this is the portfolio. Basically, you will find that Africa and Asia are the major regions in which we have exposure. Of course, CIS and Latin America regions are also there. But if you look at it as of 31st March 2021, we are yet to close our accounts. One more month is there. So we have issued 315 LOCs covering 64 countries with the credit commitments of over 31 billion. So this is the size of the LOC business. These are some of the LOCs where that virtual foundation stone laying ceremony for a nuclear power evacuation infrastructure which we created with the LOC of about 4.5 billion. In Bangladesh, in Nepal, we have supported an LOC of 100 million for road projects, rural electrification projects, power transmission projects, and hydropower projects. There is also another one which is called buyer's credit. Again, it is you are extending a credit to the buyer who will buy from India using your credit. It is almost similar to lines of credit. Lines of credit has the mandate, bilateral mandate of the government of India, whereas the buyer's credit, it is more of a joint project of ECGC, Export Credit Guarantee Corporation, and EXIM Bank of India. EXIM Bank of India will give the loan and the ECGC will provide cover through a national export insurance account, which is established by the Ministry of Commerce. So this is our portfolio. Again, West Africa, Asia, you find that more than 70% or 80, almost 80% is our exposure. These are some of the buyer's credit. One is a city decongestion project in Zambia. There was a line of buyer's credit extended for government of Ghana. This is for the railway line. And we have also extended about 91 billion for a national water supply and drainage board for the government of Sri Lanka. We have one more financing program. Of course, only one loan has been extended in this. This is for a Maitri super thermal power project at Rampal, Bangladesh. Total project cost is 1.6 billion. It is almost near completion. It's a joint venture between under the Bangladesh India Friendship Power Company and NTPC. So these two have established this joint venture, and it's given this concessional financing is extended to some projects which are strategically important to India. So the term strategically important will be decided by the government of India, and they will advise us to extend the loan, then we will extend the loan. It is also something similar to the lines of credit. Then in addition to that, I mentioned earlier, we also support project exports by way of non-funded facilities like providing advance payment guarantee or performance guarantee or bid bond guarantee. So these are the support we have provided in terms of the regions. Is there Africa, Asia? These are the regions in which we have provided guarantees to Indian companies to execute contracts in these countries. Broadly, if you look at it, construction or engineering goods, civil construction, there's one transmission and distribution of power projects or solar. So these are the projects in which Indian companies have executed contract using our non-funded facilities. So these are some of the examples in which countries we are operating, just given some samples. Now I am coming to that new initiative I told you, the Ubarte Sitare program. Ubarte Sitare is something called a rising star or hidden champion. So we need to identify companies, especially SMEs. We will identify, and then we will have to find something niche in that. See, they may be too good, but they are not exporting because of lack of something, or they are already exporting to 1, 2, 3 countries, but they want to export to 1 dozen or 2 dozen countries. So these are the two objectives with which we will identify the companies. And we are engaging with many of the startup promoting or startup supporting institutions like Indian Institute of Science or IIM Calcutta, who have this kind of what you call incubation, the MSME incubation centers they have, with whom we work and in order to identify. We have an institutional engagement with the CIRBI, and there is a value proposition because it's a joint program of EXIM Bank of India and the SIDBI. We have invested with a corpus of Ubarte Sitare fund of 250 crore with a green shoe option of another 250 crore. We do co-financing with the debt funding by way of extending loans at competitive rates. So these are some of the support we have provided or identified these companies. Like one is a manufacturer of near virgin quality recycled plastic granules. There is one unnamed aerial vehicles, that is drone manufacturer. Then there is a pharma manufacturer. So like that. So we have identified and we have supported. These are other some support which we have extended, and we are also hand-holding them also in their internationalization efforts. We also have overseas investment finance, mainly to say that Indian companies need to be a part of the global value chain. So that is why this global overseas investment finance is there for the Indian companies to venture into various markets. We provide finance for both greenfield projects as well as brownfield projects. And this is the portfolio just in a pictorial form. These are some of the examples which we have supported in the past. So just to give you some example, you will find that we have also supported one Indian company to set up a overseas subsidiary in USA, that is TCL Specialties LLC. This I have already briefly explained that export-oriented units we support. Export orientation doesn't mean that Government of India definition of 100% EOUs. We have a criteria that either 10 crores or 10%, whichever is lesser. Even if you are exporting 10%, you qualify for this program. So these are some of the examples which I am giving. Just because the audience and the theme is CLME, we are also working with the Government of India in creation of a project development structure in the CLME region. Its objective is to facilitate Indian investments and broaden the manufacturing base of Indian companies, mainly in the CLME region. We have so far identified 4 projects: multi-specialty hospital and medical college in Cambodia, multi-specialty hospital and medical college in Myanmar. There is an educational institution in Myanmar and pharmaceutical manufacturing unit in Vietnam. In these, Indian companies could go and do investment or establish joint venture or wholly owned subsidiaries. So this is what we have done, 2 mission programs to visit these countries, and then we have identified these are the 2 projects. Like one is in Cambodia and one in Vietnam. We are pursuing these 2 projects, and we have already made arrangements for establishing a special purpose vehicle, and the SPV would take up the project to a bankable proposition, which will further be offloaded to an interested Indian company. We also work with the grassroots enterprises, and mostly this grassroots activities is more like a hand-holding or providing them technical training and workshops for improvement in quality or packaging or designing, all these. But these are given on clusters basis, not on individual basis. Finally, the last slide is we do undertake research and analysis activities. These are some of the recent publications which we have brought out. These publications are available on our website. These can be freely downloaded. You can feel free to download this. One study which we have done very recently, that is in the last year, 2021, building infrastructure in CLME countries, opportunities for India. And we have also done building value chain opportunities for India and ASEAN. These 2 studies we have done. So you can download these and read more about what perspectives we have on these 2 regions. Thank you very much. I end this presentation.